Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Last year was a cracker for the share market and for super funds too. We're now officially into the new financial year and plenty of investors will be hoping the good times can continue. Subscribers to the Fear and Greed newsletter would have seen a link we shared to a great piece written by AMP Chief Economist and Head of Investment Strategy, Dr. Sean Aylmer. That was last Wednesday. In it, Shane goes through the 9 most important lessons he's learnt from his 40 years in the investment world. Remember, this is general information only and you should seek professional advice before making investment decisions. Shane Oliver, welcome back to Fear and Greed.
Thank you, Sean. Great to be here.
You are way too young to have spent 40 years in the investment world. You must have started very, very young.
Well, not really. I did spend 5 years at university, so I was well into my 20s before I started. Maybe I just look young or something. Or
maybe that's it. Tell me, before we jump into the to your rules of or the things you've learnt about investing, just very quickly, thoughts on the 2024 fiscal year?
To be honest with you, it's been a pretty good financial year for investors. As always, there's been lots of worries, the prime amongst them, inflation and interest rates. But putting aside all the details, the general trend in inflation has been down. That has led to expectations that interest rates will come down. And in the absence of severe recession globally, it's been an okay environment for profits. Now, of course, there's been the added overlay of the enthusiasm regarding artificial intelligence, which of course has supported or boosted the critical US share market. But overall, it's been a pretty good financial year. Some disappointments, obviously in Australia, inflation hasn't come down as quickly as I would have thought. So we're still a fair way off from an interest rate cut with a risk we might get another hike. But that said, the overall picture, I think, has been a reasonably positive one. Question is, will it be sustained or not? Lots of uncertainties around politics in the US, Europe. But I think the broader picture on inflation and interest rates will remain down. And ultimately, we will see interest rate cuts in Australia within the next financial year, even though I've been saying that one for a while yet. But I think we will eventually get there.
Yeah. Okay. Let's jump into your 9 most important lessons. 1 July today, I think, as good time as any to talk about these things. Number 1, there's always a cycle chain.
There certainly is. And this is something that periodically we like to think, the rules have been changed and cycle's not going to be returning, and investors pile in thinking that things will be sustained forever. And then, of course, we get hit by another cycle. Many cycles, of course, just then set the scene for the next one. For example, we had the tech wreck that led to low interest rates. Low interest rates then set the scene for the GFC, which then gave us the next cyclical downswing. Over the last 40 years, I reckon I've seen some sort of crisis every 3 years. I started in 1984, bang on track with that average. We got the 87 crash. A few years later, the S&L, the savings and loan crisis in the US, the recession in the early 1990s, Asian crisis, hedge fund problems, tech wreck and bust, the mining boom, of course, in Australia, which then again went bust after a while, and the GFC. And of course, since the GFC, we've also had crises with the Eurozone situation, which seems to keep popping up every so often with the issues in France. And of course, the pandemic. So the beat goes on. Each time we had one of these crises, the tendency is to say, well, it's unparalleled, unprecedented, it's a defining event. The whole world has changed. And then, of course, we just see another cycle and then it all goes round again. We're back to a new unparalleled event. That's just the reality of life. The trick for investors is to accept that these things happen, focus not on the cycle, but on the long-term trend, and make sure you don't get blown off by cyclical swings.
Now, related to that is your second tip: the crowd gets it wrong at extremes.
Well, this one's very important. And again, we often forget this, that the crowd is quite useful. It's often the crowd that pushes the market up. But once you get to an extreme, and this comes back to investor psychology, that we're all impacted by, but we do have a tendency to project the current state of the world off into the future. We tend to look for evidence that confirms our views. We tend to be overconfident, particularly males, and we have a lower tolerance for losses than gains. So as a result of all of that, when times are good, people assume that it will be sustained. They focus more on the evidence that supports that as opposed to evidence that might question that. And of course, they pile in. And then, of course, we go from ultimately in a downswing, we go from depression and people feeling depressed rather, to ultimately a situation where we have euphoria. And of course, when everyone is into something and you go to a family gathering or a barbecue and they're all talking about the same thing, whether it's Bitcoin or tech stocks or whatever, it's often a good sign that we're at the top. And so you've got to be a little bit skeptical about the crowd when it gets to an extreme. The old rule of thumb was if you get in a taxi and they start talking shares, that's a concern. If you get in a taxi and they're not, then maybe it's okay.
Right. Again, 3 follows on from that, and it's a little bit self-evident, but really easy to forget. What you pay for an investment actually matters.
It certainly does. Obviously, there are guidelines to that. Share markets, we focus on PEs, price to earnings ratios. The higher, the more expensive the investment, the lower return potential you get. And of course, the other one, of course, is rents, rental yields, dividend yields, bond yields, interest rates. They're all yields of some form. Obviously, the higher, the better. Right now, we're at the low end of the range for the dividend yield on the Australian share market. If you look at data over the last 100 years or so, that does sort of suggest lower than average returns out of the Australian share market going forward. It's not disastrous. It's still projecting okay returns. So you've got to add in the franking credits. But this is not 1982, a couple of years before I started my career, when dividend yields were around 8 or 9%. This is 2024, and dividend yields are down or just below 4%. And in the franking credits, you're around 5%. So that obviously means that the fuel in the tank is not as good as it would be if we had a much higher dividend yield or a much lower PE.
Stay with me, Shane. We'll be back in a minute. I'm speaking to Dr. Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. Okay, number 4, and I love the quote from Kenneth Galbraith, J.K. Galbraith. John Kenneth Galbraith? I'm trying to remember that.
It is Jonathan.
It's Jonathan Kenneth. His great phrase, which you've quoted, there are 2 kinds of forecasters, those who don't know and those who don't know they don't know. Basically, it's hard to get markets right is number 4.
It certainly is. Most economists like to pretend that they know, and some of them don't know that they don't know. But the point about all that is, and I'm not meaning to disparage economists, you have a bit of luck here at times. There's another great quote I like from Roger Federer, where in a recent speech he indicated that he won 80% of the 1,526 singles matches in his career, but of the points, he only won around 54%.
I've seen that, yeah.
So almost half the time he lost, almost half the time, just a bit over that he won. So you got to take from that as an economist, as an investor, you're going to get it wrong a lot of the time. You got to allow, there was another great reference many years ago to tennis, to amateur tennis, and investing is a bit like that. It's a bit like what they call a loser's game, where the trick is not to play to win, but to play to avoid losing. Boxing after around 15 is similar to that. You've just got to hang in there. You're not trying to get the good punches, just trying to hang in there longer than your opponent. And I think it's the same with investing. We have to be humble. We have to admit that at times we, like everybody else, get exuberant, so we miss the tops, and we get too pessimistic at the bottoms and miss the bottoms. This is just the way it is. Trying to time markets, you can get lucky and get it right, but a lot of the time you won't get it right, and you can lose a lot of the money in the process. Another one on that, it reminded this many, many years ago, there was a guy who had an Australian petroleum company. He sold it and he used the proceeds, not so much the proceeds. This was 1986, I think it was. He sold the Aussie share market short, so thinking it was overvalued. And of course, the Aussie share market kept going higher and higher into 1987. Then it crashed. Unfortunately, when you sell shares short, you've got a limited time period there, and his time period was up, and he lost his fortune because he had to buy the shares back at an inflated price to pay back those he borrowed the shares from, and lost a lot of money. So you can often get the basic view right. He was arguably right. Shares were overvalued in the mid-'80s, but he got the timing wrong and lost anyway. So you've got to be really careful when you're trying to time markets.
Number 5, investment markets don't learn. Well, not for long. That's
right. We learn from the experience of the last few years. But as time goes by, new investors come in and all the lessons are forgotten. And so the same mistakes are repeated over and over. The details will change. And this is something that Mark Twain is said to have said, history doesn't repeat, but it rhymes. And so you can see a similar pattern in all crises. They start often when everyone's euphoric or very happy. Markets then have a fall, and then they set up a new low eventually, and then they take off again. So we go through that same pattern, but all the details are different, which is why people get so confused and thrown off. But there is a quote that I love from the German philosopher George Hegel. The one thing that we learn from history is that we learn nothing from history. The mistakes we've made in investment markets, we will see over and over. They will be pushed to extremes on the high side and the low side, and there's nothing that will change that. It would be very nice to think that we can stop the cycle, that regulators can regulate it away, but that's not going to happen.
Okay, number 6, we're running out of time here, but we'll keep going. Compound interest is key to growing wealth. Again, self-evident, but many people don't do it.
That's certainly true. Don Stammer, who was a well-known Australian economist, sort of used to point this out over and over, that if you want to grow wealth, you've got to have good exposure to growth assets, and it's like magic. Compound interest is where returns grow on top of returns. So $100 at a 10% return becomes $110. The next year, your dollar amount by which you go up is even bigger. It gets bigger and bigger through time, and it goes exponential. So the key is to make the most of compound interest, not get blown off by cyclical swings.
Number 7, it pays to be optimistic.
Well, this is very important. Some people have accused me of being perennially optimistic about things. It's partly maybe
they might have a point, Shane. They might have a point.
They may have a point, but it's partly genetics. I think I was born in a nice part of the northern beaches of Sydney. Great family, stability. They love me. They encourage me to study, do well at university. Blah blah blah. But I think I've also learnt from looking at share markets historically. 8 out of 10 years, the Aussie share market goes up. 7 out of 10 years, the US share market goes up. If you're going to get obsessed with the 2 or 3 years that it goes down, odds are you'll miss out on the 7 or 10 years that it goes up. So it pays to be optimistic.
Number 8, I love this. Affects many, many things in life. Keep it simple, stupid. The KISS principle.
It certainly is important, this one. And unfortunately, in the investment world, we have a habit of making things more and more complicated. If I think back to portfolio insurance back in 1987, it was relatively simple, but by the GFC, it had morphed into very crazy things like CDOs, which I'm still struggling to understand. But there's this innate tendency for investment people to complicate things. And I think that just means that we miss the big picture. We end up lost in the details. Key is to keep it simple. If you don't understand it, I still struggle with Bitcoin a little bit. Then maybe you should stay away.
Number 9, I think this is a great one to finish with. You need to know yourself.
Well, I think this is critical. A lot of people don't. They don't understand the way markets work. I think people need to ask themselves, what would you do if the share market fell 20%? If your savings fell 20%? If you can just say, okay, well, this happens, I'm okay with it, I can sleep at night, then, maybe shares are for you, growth strategy is for you. But if you would say, well, I'd want to get out of here, then that's probably a bad response. And you need to find ways to manage that. One may be to get a financial advisor as a coach, just find ways to exercise discipline. Or alternatively, you've got to have a more conservative strategy rather than thinking that you'll be able to get out at the right time and get back in at the right time. Odds are you won't. You'll just get it wrong and your psychology will blow you off. So I think it's very important to know yourself, and that will determine the type of investment strategy that is right for you.
Shane, they're your 9 tips or the 9 lessons you've learned over 40 years in the investment world. Are you looking forward to this coming financial year?
Look, I'm always looking forward to what may come ahead. I must admit, sometimes after 40 years, you find yourself going in circles. It seems like we're in Groundhog Day.
Yes.
Not a week goes by when the topic is not inflation and interest rates.
Yep.
And then if we're not talking about that, we're talking about the possibility of crises in Europe or Trump as president in the US. So we seem to be stuck spinning around talking about the same issues. That sometimes that depresses me a little bit. We keep going in circles, but that, as you say, is the cycle and not learning from history. But I am looking forward to the next 12 months. I know there's a lot of fear around. I think things will turn out okay. I think we are seeing the worst we've seen the worst in terms of inflation, and that ultimately means lower interest rates. And if we do have a recession, and risk there is significant, we do have one, not our base case. I think it will be a relatively mild one because we haven't seen the sort of spending or investment booms that normally precede severe recessions like we had around the time of the GFC in the US or in the early 90s in Australia.
Shane, thank you for talking to Fear and Greed.
Thanks, Sean. It's been my pleasure.
That was Dr. Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.